Most founders get valuation completely wrong. They either name a number too early and scare off investors, or they accept a high valuation with deal structures that destroy their exit. As a startup lawyer, I've helped founders raise hundreds of millions of dollars across angel, pre-seed, seed, and Series A rounds. So I've seen what works. That's why in this video, I'm gonna break down exactly how to calculate what your startup is worth, how to structure conversations with VCs, and how to protect yourself from the traps that most founders fall into when raising capital. Let's dive in. The first step is to understand pre-money and post-money valuations. This is foundational knowledge every founder must have. Pre-money valuation is your company's valuation before investment is received. Post-money valuation is your company's valuation after the investment is received. This difference is crucial for understanding dilution. The reason why this matters so much is that the same $10 million check at a $40 million valuation can mean very different things. $10 million at a $40 million pre-money valuation means a $50 million post-money valuation. $10 million at a $40 million post-money valuation means a $30 million pre-money valuation. That's the difference between 20% and 25% ownership. So you should always ask investors if they're referring to pre-money or post-money valuation. The numbers and words can be switched around to mean different things. Definitely don't assume you know what investors mean. Next, let's talk about safe deals. A safe or simple agreement for future equity is the most common way to raise early stage funding. They work differently than priced rounds. Instead of setting a hard valuation, you set a valuation cap or you offer a discount. This is supposed to let you avoid the valuation conversation in the early stages. But the thing is, the cap often functions like a valuation anyway. When you raise a safe, you're not selling shares yet. You're giving investors the right to get shares later when you do a price round. A price round is when you actually set a valuation and sell shares. This usually happens at Series A. The valuation cap determines the maximum valuation at which those safe investors convert into shares. So if you set a $10 million cap and then you raise your Series A at a $40 million valuation, those safe investors still convert at 10 million, meaning they get more shares for their money. That's why choosing a cap is basically choosing a valuation. It sets the price your early investors will pay. The only time the cap wouldn't matter is if your priced round ends up lower than the cap. But that rarely happens because in the early stages, the idea is that your company is increasing in value. Either way, the most important thing is modeling your dilution, but I'll talk more about that later. By the way, if you're preparing to raise and you want to make sure your legal documents are investor ready before you start these conversations, click the first link in the description and book a free consultation with me. I'll help you understand exactly what you need to have in place so you don't get caught off guard. But back to the video. Use comparables to anchor your valuation. You also need to know your market inside and out. This is going to give you credibility in front of VCs. You should look at who else is in the market and what stages those businesses are at. This is where you identify competitors and similar companies. Here's how to do it. Start by looking at similarly situated competitors in the market. Analyze stage, customers, and features. Find out what valuation they raised at in various stages of their journey. There are tools like Crunchbase and PitchBook that you can use to look at these numbers. You can then use these comps in conversations with VCs. You can point to a comparable company and say something like, for this company Series A, they raised at a $50 million valuation. Then connect it. We're raising our Series A. We're similarly situated. We have similar traction, similar features, similar customers, and we should get a similar valuation. And it's important you know the benchmarks for your round. There isn't a hard and fast rule, but there's general guidance in terms of benchmarks based on round. For example, angel rounds are typically $500,000 at a $5 million valuation. Seed is usually $2 million at a $20 million valuation, and Series A is often $10 million or more at a $40 million valuation. valuation. These vary by market and traction, but this gives you a ballpark. Different rounds have different amounts raised and valuation expectations, but again, it varies based on your specific startup. This will just help you understand if you're in the right range and give you credibility. Focus on dilution, not valuation. As I mentioned briefly before, you should focus on dilution, not valuation. In any fundraising round, you don't want to offer more than 20%. 20% per round is the ideal amount of equity to give away, and VCs think this way too. They're not just focused on valuation, they're also focused on what ownership position they want to take. This is called their strike zone. Some VCs scale their investments across stages with different target ownership stakes. You can use this to your advantage. Ask VCs what ownership percentage they typically target, and ask how much they expect to own for different valuation ranges or different rounds. If their target ownership aligns with the dilution that you're comfortable with, the valuation will work itself out. Protect yourself from bad deal structures. When speaking to VCs, you should watch out for the option pool shuffle. This is a common way VCs lower your effective valuation while quoting you a higher number. The investor says something like, "I'm going to invest at a 10 million post-money valuation," but that's going to require a 20% pre-money option pool. What this means is you have to create the option pool before they invest. So the option pool dilutes you, not them. The headline valuation sounds great, but your actual ownership is worse than you think. The best way to fight this is to go into the negotiation with a hiring plan. Build out your org chart and assign equity to all those positions. Then show the investor, for example, you've planned your org chart for the next 18 months and you only need a 10% option pool, not 20%. As well as avoiding option pool shuffles, you also shouldn't chase headline valuations. Founders get excited about high valuation numbers, but those high valuations often come with structured terms. Here's what those structured terms can look like. A 2x or 3x liquidation preference means the investor gets 2 to 3x their money back before you see a dime. Participating preferred means that after they get that, they also take their percentage of what's left. These terms can mean investors walk away with most of your exit while you're left with next to nothing. That's why you need clear terms that protect your exit. A 1x liquidation preference, non-participating, is what you want. That means the investor either gets their initial investment back first, or they can convert to common stock and get their percentage ownership share of the exit. So if they own 10% of your company, they get 10% of your exit proceeds. It's better to have a lower valuation with clean terms than a higher valuation that leaves you with nothing. Lower valuations also protect you from down rounds. If you raise at an inflated valuation, you have to justify it the next round. But if you can't, a down round damages your credibility and the whole morale of your team. Next, I want to talk about stacking your wins. It's important you don't swing for the home run in the early stages. It's okay to raise less money at a lower valuation. Stack your wins and use them to justify higher valuations later. For example, you raise a $500K pre-seed round at a $5 million valuation. Then you raise a $2 million seed round at a $12 million valuation. Then you raise a $10 million Series A at a $40 million valuation. This works well because the wins compound on each other. It puts you in a stronger position when negotiating with VCs, and you're building a track record of progress. How to handle valuation conversations. You also shouldn't name your valuation yourself. Instead, let the buyer name the price. In any deal, the buyer should name the price. The VC is the buyer. If you name a number first, you might come in too low and leave money on the table, or you go too high and scare them off. VCs will ask what expectations you have about valuation. You might be tempted to name an actual valuation. Instead, anchor by giving a general range without saying your actual number. Then turn it back on them. How is the market market pricing rounds like ours these days. Here's a script you can use. We closed our last round at a 5 million valuation cap and raised 500K. We closed the round 12 months ago and we've made great progress. We're hoping to raise 2 to 4 million. But honestly, we know the market is going to tell us the right valuation. As founders, we aren't expert investors. You are. You know the market better than we do. We're looking for a fit with the right VC rather than optimizing for the highest price. So how would you think about valuation for a company at our stage? That approach works in most situations, but there are some exceptions to the rule, and there are times when you should absolutely name the valuation yourself. If you're raising from strategic investors, meaning companies, not VCs, who invest because your startup aligns with their business, or if you're raising from a large pool of investors, this is because naming the valuation with large pools sets the standard and it'll streamline the process. For example, you can go to 40 different investors and say, we're raising 500K at a $5 million valuation, non-negotiable. Here's a safe. Always run a competitive process. No matter what, you should always run a competitive process because this is how you get the best deals. Always be pitching. Never stop talking to investors until the money is in the bank. Treat every VC meeting as market research. Every meeting is an opportunity to get feedback from experienced investors. Ask how they're assessing market valuations and ask how they're thinking about your valuation. Then use what you learn to your advantage. Take insights from one investor into the next conversation. Create leverage by having multiple investors interested. The best valuations come from competitive processes. So if you're an early stage founder who's raising investment or preparing to raise, and you want to make sure your legal documents are investor ready and you're protected in these negotiations, then click the first link in the description and book a free consultation with me. In that call, we'll analyze your current situation and I'll help you understand what you need to have in place before you start talking to investors. Valuation conversations get complex fast, especially when you're dealing with experienced VCs who know how to structure deals in their favor. So if it's something you'd like help with, click the link below. And if you want a full beginner's guide to understanding startup equity, then watch this video next.